G'day guys, welcome back to episode 54, Money in the Tank. It's good to have the tankers with us again for all things financial information and up-to-date details on what's going on in the world of the markets, and also some fact-checking along the way as well, which we tend to do every now and then. My name's Joel, Seach, Principal Advisor, Harpel FG.
And I am Arnie, Finance Professional.
And we've had some technical difficulties with Brad today. He will most likely tap himself out of this episode and come back in for the following one. So he apologises. I think he's still in Singapore, is he?
He's still, he's in Singapore now.
He's over in Singapore. So he got the one from Bali done, but he's struggling with Singapore, which is it should be the other way around, you'd think. But from a technical perspective, Singapore being a bit more modernized with internet and whatnot. But anyway, we'll have Brad back with us next week. And without further ado, we've got a ripping episode for you guys today. So we're looking forward to taking you all through it. We're going to have some Renee rivkinisms as we go. We've got some inflation Australia information of what's happening in the world of inflation and month by month in Australia, which is quite interesting. Some data came out the other day. Some markets and China stuff. Arnie with some quick fire rapid news. And we've got a couple of fact checks from last week's episode, and then some fun Elon Musk information, which you can't do a podcast without, can you?
Absolutely not. We've got to include Elon in every single pod if possible.
Absolutely. Keep the drinking game going. So the one I don't have the Bible with me at work today, unfortunately. So we've got some Google, our best friend today, and I spoke to Arnie before the pod on because we do some preparation for the podcast. Maybe you believe or don't believe, we do some prep. Chartists. So I've done a couple on Chartists before, and this one tickled my fancy. It was quite funny. I've thrown out the challenge many times. Show me a rich Chartist. I can show you plenty of rich fundamentalists. Show me a rich Chartist, and then I'll change my mind on charts. I've offered rewards of up to $10,000 for the introduction to a rich Chartist. No one has ever claimed that reward. That's got to tell you that the Chartists are basically in the same field as psychics and fortune tellers.
So that's big riv. I think you said Elon Musk and you confused me for a second there, but I'm with you. Yeah. So rivkinsrules.
Apologies. That's a riv quote, that one. So
I love that one, but if it was modern day, riv would be wrong there, because Keith Gill, aka Deep Effing Value, aka Roaring Kitty, the bloke who made all his money on GME.
Chartist?
Well, he is a fundamentalist and a chartist, but he actually uses charts in the way that you have described that Rivkin used to use charts, is that he would look at them for the historical to see the trends, in particular in cyclical industries. So I don't know, maybe Rivkin's covered himself a bit there by saying that he thinks it's useful for historical purposes in a different quote, not that quote, but yeah.
So there you go. Interesting. But we love the Rivkin quotes here, so we'll keep them coming. And without further ado, Arnie, can you tell the listeners as well, because we forgot to do it the rundown, as to where the tankers can get us at?
Yeah, please get us at Money in the Tank on YouTube, Instagram, Twitter, and Facebook, and leave a like, comment, subscribe on the YouTube, and click the bell if you be so inclined, because that helps us and helps the algorithm. So thank you very much, tankers.
And we did say it's on last week's episode, it's illegal to view and not subscribe and ballot. So we need the data feeds and the listeners and the aggregates coming through. So we appreciate it, and we appreciate the feedback. So get us on any of those means, and we love hearing from the listeners with good Q&As, and we've got some cool topics to discuss today that have come from some of the listeners as well, which we appreciate. So in terms of the podcast today as well, it's general in nature. So please seek your own personal advice when it comes to any investment decisions. So we always like to talk generally here and educational purposes only. So today's all about that, and hopefully you guys will get a lot out of it. So in terms of the current situation, Arnie, where do you want to start?
Well, maybe you take us through the inflation data from Australia, and then we can both comment on Jay Powell's speech at wherever it was overnight. I forget where he said it. So sure. At the Hutchins Centre, we can talk about that, and we can talk about inflation as we often do, and Also, we've got a few fact checks, and we can talk about Elon Musk and Twitter, because there's a lot there, in particular that email, but also I've got some news items about it. So
Yeah, for sure. And I don't think we'll ever, I was thinking about the podcast yesterday, is how much we've talked about inflation. I don't think we'll ever talk about inflation as much as we are now. I don't think we've ever talked on the podcast before this kind of current period of inflation creeping up again. It's amazing.
I think you're right, mate. I think we are living through a very interesting time for the world. And I mean, obviously inflationary scenarios happened before, but well before our time. So it's just to actually live through one is, I mean, it's not great, but it's interesting, it's interesting to see how it all unfolds. So
yeah.
yeah.
And the interesting thing of this kind of market update with relating to this monthly inflation data in Australia is we're living through it, but we aren't as bad as maybe some of the other parts of the world, which I know we have indicated before on the pod.
Yeah, no, for sure. We're doing pretty well here. I think it's I mean, people are still feeling it for sure, but I think yeah, places like America and obviously some of the other places like in South America that we've talked about have been struggling for a while. But yeah, people are feeling it. It's a tough thing.
Yeah. So the latest, I guess, with the inflation data, a number of pods ago, we mentioned that Australia historically had only done 3-month by 3-month inflation data, and sort of had a bit of people had a bit of a laugh, or countries had a bit of a laugh at. I think it was Philip Lowe at one of the big events they do globally. So in a time like this, the monthly data is so crucial, and I guess they've never really had the need or the feel they need to have the monthly, but because it used to just be 3 monthly. So when things are moving so quickly at the moment, monthly is very crucial. So overnight, the other night, Treasurer Jim Chalmers welcomed cautiously the latest consumer price index, which showed a decrease in the annual rate of headline inflation to 6.9. Despite easing in October, most economists, and economists you take with a grain of salt, believe that inflation is still yet to peak. So the October indicator from the ABS was well below market expectations for a 7.6% annual increase, and was down from 7.3 in September. So it shows there's reasons to be carefully optimistic, and we're potentially getting near the inflationary peak, but not there yet. So Treasurer noted that the figure does not yet fully include the price impacts of the recent floods, and also the impact of the higher energy costs of recent months as well, which, alluding to before, some of the other countries in Europe are really feeling the pinch from an energy standpoint, where we are better off at the moment in Australia in that regard. Any thoughts initially on that, Arnie, before I go through the rest of the information here?
General in nature, but interestingly connected to the energy information you're talking about, I was noting some tweets the other day from certain people on FinTwit, and I forget who, that there is a huge divergence in the moment between the price of stocks in that sector and the price of oil at the moment, which has crashed a bit. So interesting to note what's happening in that space, that they're still those large stocks are still propped up, even though the underlying cost has crumbled a bit. So we'll see what happens there.
Okay, yeah, interesting. So acknowledged, I guess, in terms of there's a number of signs of the economy. This is one of the economists that in this article, that may be starting to cool, including recent falls in measures of retail sales and job ads and consumer sentiment. So retail sales and job ads are one of the first things they look at. However, noting that it's still the tightest labour market in Australia in 50 years. So, the wage growth side of things, when you've got a tight labour market, it means there's less pool of people to get these jobs for you. So you've got to offer a higher wage to incline someone to take a role on. And that then has a flow-on effect to inflation, which they don't want to see happen. And he sort of noted that Australian households are quite cashed up from the recent lower interest rate environment we've had the past couple of years, with higher repayments being there, and sort of people staying at the higher repayments. So there's more and more in redraw and offset. So the higher mortgage repayments haven't yet deterred the shoppers. So the retail sales were up about 12.5% over the last year, which is also a thing in terms of like people this last year have been able to get out and do things again, and go out and spend and go to the shop. So it was a bit of a change from last year too, obviously. So that sort of adds fuel to the inflation story and the economic activity, and they still expect it to climb to 8% by the year's end. So the RBA's still got a bit of work to do. Mm-hmm. So it'll be interesting to see what the RBA does at this next meeting, which will be next Tuesday, first Tuesday of every month. And whether that's a 25 basis point or a 50 basis point yet to be decided, because they don't meet in January, don't forget. And then according to the ABS, which is the Australian Bureau of Statistics, the most significant contributors to the annual rise were new dwellings, so 20% contributors to inflation, automotive fuel, 11%, and fruit and vegetables up 9.4%. So they were sort of some of the highest contributors to the inflation because of the building construction activity and ongoing shortages of labour and materials contributed to the rise of the pricing there of new dwelling costs. And the automotive fuel was up, obviously, because of the federal government's cut to fuel excise, which came off from September. And the food and alcohol's gone up by an annual rise of 9.6% in September, and it's up to 8.9 in October. So it's come off a little bit. So that's interesting. Travel as well is increased. So travel's gone up in terms of weighted baskets. They've increased the travel side of things there to put that into the basket of info. But yeah, as we're positioned from a country in Australia compared to some of the other countries around the world, our inflation overall is a bit tighter than, or a little bit softer than some of the other bigger nations around the world.
Interesting, Jolie. And you were mentioning just then the relationship between higher inflation and unemployment, and how when there's high inflation, you typically see lower unemployment.
Yep.
And that creates, I guess, competition in the labour market, which will then force wages higher. That was actually referenced by Jay Powell in his speech, saying that that's what they're observing as a data point, that they're seeing, record low unemployment in America, which is causing pressure on the wages market. But one quote here, which I'll say, which is I had it in my news items, but he basically said that initial surge of inflation was not related to wages, but wages are going to be important going forward. But for most workers who are seeing increases in wages, it's being offset by how high the inflation is. So it's not yet helping them, or it's not a net positive, the wages, I guess.
Yeah, it's a really, really good point, Arnie, and it can sort of start to become a roundabout and go, it just sort of continues to go in a spiral. You get a higher wage growth, you pay more for this and that, and then you ask for higher wages and you pay more for this and that. It's not a great thing, and that's where they try to find equilibrium when they're making these changes to interest rates. Is they want to actually see a little bit of unemployment. They don't want to see unemployment too low, because it's actually not a good thing, but they don't want to see it obviously rampantly high. They want to see an equilibrium. It's the same with interest rates. They don't want to see them going too high, but they want to see it enough where you see Meta, Facebook, and some of the big tech companies, because their interest rates have gone up, the cost to run the business has gone up, they've had to lay off. So it's not necessarily an overly bad thing of the economy, because those people will, find new jobs, maybe at a lower wage. All those things sort of play out into this melting pot of data.
Yeah, anecdotally, Intel has announced that they're going to be cutting lots of jobs as well. So big employer, a lot of people. It's happening everywhere. So as we sort of covered in one of the previous pods, but do you want me to run through like the highlights of the meeting from Jay Powell, and we'll go from there?
Yeah, that'd be great, mate. Just give us the laydown of the recent Jay Powell meeting, and how the markets have reacted, and where they see themselves as well, because the US is the big hitter of all this.
Yeah, well, in a nutshell, Jay Powell basically sort of said, well, we're not there yet. Need to, keep increasing. But he did say, and I'm paraphrasing here, so this is not exactly what he said, but he said that they can slow the pace of rate rises as soon as the December FOMC, which I think is the 2nd or 3rd of December. So it might come in before our own Reserve Bank of Australia meet and discuss what they're going to be doing. But he did say that they will need to hold, as they've said before, so he pretty much reiterated everything he said for a while now. They need to hold the policy at restrictive levels, and he said for some time, wasn't definitive, and that ongoing rate rises or increases may be appropriate because it has a long way to go before bringing inflation down. He also said that there would likely be a need for somewhat higher rates in 2023 than what they had anticipated in September projections. So if you remember in September, I think they were projecting they were going to have another 1.25 basis point rise by the end of this year. And at the last meeting, they did 0.75. So everyone's still expecting there to be a 0.5 basis point increase in December meeting. And then it was alluded to at that meeting that they might raise another 0.25 in 2023. JP are now signaling that it might be there might be a need for somewhat higher rates than 0.25. So, but somewhat higher. The language is not. It's not hawkish. Is it dovish? I'm not sure, but I think that's the way people might have interpreted it. Expects core PCE inflation to ease to 5% from 5.1%. So, yeah, that's the interesting points from his speech. Before he spoke, the Fed's Cook also made some comments saying that it was important to be cautious about interpreting the yield curve inversion, which has been happening for some time. They don't have an in-house definition of recession at the Fed, he said as well. So I guess that's an interesting one. And Cook also said it would be prudent for the Fed to hike in smaller steps moving forward. How far they go with rate hikes depends on how the US economy responds, and too soon to say that the inflation trend is turning more friendly. So off the back of that, markets went ballistic. I don't know exactly how much the S&P or the Nasdaq were up, but
yeah, the Dow was up about 700 points. The S&P was up about 3.1%, and the Nasdaq was up 4.4%, and the Dow was 2.2%.
Yeah, well, since September, Jolie, the Nasdaq is up. Sorry, the Dow is up 22%. So that's a lot in a short space of time. I was considering we're coming off, what the June lows, whatever they were. That was like when it sort of hit its lowest point for the year. So
quite a kick, isn't it?
Seems like sentiment has picked up just in time for the Christmas Santa Claus rally. And then we could probably expect, general in nature, would probably expect a little bit of selling from in American markets so they can get, I don't know, just before the end of the year and sort of reset for January. There's those sort of cyclical timing things that happen and how people manage their finances. Yeah, so
the Christmas rally just in time for us to release our guesses from last year and hopefully be not too far off the pace with what we estimated in terms of markets to finish, because it wasn't looking good for a while with our predictions, I don't reckon.
I think I'm well off because I think I was bullish on nearly everything except crypto. I think I might have nailed crypto, but I think on the indices I was like, and you know what, my thought pattern at the time was like, if this situation in Ukraine resolves, everything should get back to normal by the end of the year. But that obviously hasn't happened. So I forget what I predicted, but I think I was way off.
I thought we did the predictions before the Ukraine-Russia thing, but maybe we didn't. Yeah.
No, it had definitely, I think it had just started. Or maybe it hadn't kicked off significantly, but yeah.
But interest rates would have been really low when we did it. And yeah, that's the thing about kind of predicting the market. It's really, really unpredictable, very hard to predict. And it'll be interesting when we do go back to that podcast. Probably in a couple of weeks, we'll do the summary and the wrap up for the year and go to our guesses as to where things were going to finish. And that's sort of why it's very, very hard to predict these things, even the experts. And that's kind of goes to your point, Arnie, with the Powell and saying the Fed didn't really want to give an indicative timeline as to how long they'll be restrictive for, because they can get held to account, like the governor in Australia did low when he said interest rates will be low for 2024, and then you start rising them and people have felt the pinch and really kind of put him over the coals for that. So their comments do have a lot of sway, and they don't like to be held to timelines because it is such a moving month-to-month economy at the moment, and the inflation is a month-to-month thing. You can see just the change of language and the change of updates as we've been going through this journey with you guys and the tankers the past 6 months. It's been kind of tweaked and changed and adjusted every month in line with what they're seeing and what's coming through.
It's such a hard balancing act for those central banks, and Dr. Philip Lowe probably should know better than to give hard timelines, or maybe even call that maybe not hard timeline, like a loose timeline. But you got to be, maybe a lesson he would take from that is you got to be a bit more vague about what's going to happen, because he had to respond in kind to what was happening in the rest of the world, and he had to go against what he had said previously. And anecdotally, I know you and I have heard stories about people who were maybe new home buyers, jumped into the market when rates were low, had a variable mortgage, and now all of a sudden rates are through the roof and their repayments are, a lot more than they thought.
Yep, absolutely. So, and they usually are quite vague with timings, but I think in defense of Lowe in that time, it was a once in a generational type thing that we'd gone through, and he wanted to try to instill confidence in the economy and the Australian people that we're here to help support the Australian economy no matter what. And that's probably what his language was leading to.
I 100% agree with you. I feel like he had the best of intentions, trying to provide certainty, trying to provide stability, and it's just like I said, he had to be reactionary. So it's just one of those things.
Kicking on to the next subject, Arndog. So we've spoken about inflation. We've spoken about the Fed's meeting, or Jay Powell's speech overnight. Did want to touch with the listeners on the goings on with, I guess, the China situation and the markets and how that's impacting?
Yeah, interestingly, I mean, we touched on this last week, and I believe you had a bit of a fact check on Brad's numbers in the Apple factory because he said 2 million people in the factory. What was the actual?
So we had one of our listeners of the pod. We had the inside scoop. He works for Tesla. Shout out to you, Loams. He mentioned that he thinks it's about 200,000, maybe, and the 2 million might have been 1.8 million top heavy in terms of factory workers. But I think Brad missed a crucial digit of a zero.
No, I think Brad went back and fact checked himself after that, and he said that that manufacturer employs 2 million people in different factories in that region.
Yes,
but that one factory was 200,000. So
yeah, and he put the screenshot in the YouTube clip. So if you were listening to the pod and not viewing it, you wouldn't have seen the screenshot. So we're chipping in for that one there with Brad. And I've got a first home buyer update after this segment on Wayne's, our property advocate, that wasn't quite sure of the exact detail. He's been kind enough to send that information through, so I'll update the listeners of that one as well.
Yeah, just before, I'm just parking China for a second just to say that I really enjoyed the podcast that you two did with Wayne. He was super interesting. So shame I missed that one. But yeah, China, the lockdown. So they have maintained, even in the face of pressure, that they are going to stick with a zero COVID policy. And there's been like certain news items at the moment sort of saying that it's unsustainable for the Chinese economy. And in particular, one large world body, the IMF, has come out and said that they think there needs to be a gradual, and I'm paraphrasing again, sorry guys, but there needs to be a gradual recalibration of that zero COVID policy, and that if they do not change it, then these new COVID outbreaks are going to weigh on the Chinese economy in the short term, and therefore the rest of the world. Because I think, correct me if I'm wrong, Joel, but I think it's like somewhere in the ballpark of like 30% of all American goods are manufactured in China. Or maybe that's wrong. Maybe that's too high. Anyway, they manufacture a lot for the entire world, and when they get shut down, the world gets shut down, and we're going to see some more supply chain pain if they try to keep maintaining that policy. But yeah, Apple in particular, I think they suffered some hit to their iPhone production, something in the approximation of around 6 million units. I don't know if you guys mentioned it in the last pod, but yeah, that was an interesting number.
They're usually not a country to protest, China, and when protests happen, it can be met with, some pretty blunt force from the army or the police or the government. So it'll be interesting to see, I guess, what transpires, and if there's any, if the government laxes or gives any wiggle room to what they're trying to enforce at the moment, if more and more people begin to protest. So I think the protests were maybe in the hundreds initially, from what I read.
Yeah, there was a lot protesting, and I agree with you. So we'll see how that unfolds. Hopefully it can become resolved. I think us in the West, I know you guys did speak on the Chinese sort of mindset and perhaps the government's mindset behind why they're sticking to their guns, but I think everyone else can sort of see now that lockdowns were damaging, and we'd rather sort of participate as best we can with our economy whilst trying to manage COVID around it, rather than trying to sort of stomp it out.
Yeah, good one.
So what was the fact check from the Wayne podcast?
Yeah, so Wayne from Your Property Advocates has been kind enough to flick us through just an update of email in terms of the first home buyers grant. And I guess we'll talk, I believe, Victoria specifically for this one. So general in nature, seek your own advice, or go reach out to someone like Wayne as a property advocate to help you with this if you're in this situation. But first homeowners grant. So if you're buying or building a new home valued up to the amount of $750,000, you may be eligible for the first homeowner grant of $10,000. To be eligible, the home must not have been previously sold or occupied. And it's a cutout threshold. So it sort of begins the first home duty concession. So the stamp duty concession, a one-off duty concession for a PPR, principal place of residence, valued up to $600K, or a concession with from 600,000 to 750, there's a cutout ratio for the first home buyer grant and concession as well. So check out that information for you. And there's another one as well, which I haven't looked into in too greater detail, is the Victorian Home Buyer Fund is a shared equity scheme where the Victorian government makes a financial contribution to the purchase of a home in exchange for an equity share in the property, which participants can buy back over time. So through the scheme, the Vic government provides eligible participants with a contribution of up to 25% of the purchase price of the home, and participants need to contribute a minimum of 5% of the purchase price and cover any acquisition costs such as stamps and conveyancing. The remaining amount is to be secured through a home loan, from a partner lender. So yeah, that's a new one the government brought out, I think maybe 12 months ago or so. And the participants are required to buy back the government's share in their property over time through refinancing using accumulated savings or upon sale of the property. The Victorian government does not charge interest on its investment in the participant's home, but shares in any gains or losses proportionate to its share of the property. So for more information on that, you can visit the Victorian Home Buyer Fund, vic.gov.au//homebuyer. So yeah, all the above has strict eligibility rules. So talk to a great mortgage broker or property advocate around that as well. So yeah.
That's a very interesting. I hadn't actually kept up with that policy. I remember when it was announced, that one about the government covering part of the cost, and to hear that they're not charging interest, but will take some of the gain or the loss is interesting. And I wonder if they're going to take some of the gain, like when you repay it, if they're going to have some sort of revaluation every year to see like how much it's worth, if there's an increase or a decrease.
Yeah, I'm not sure the inner workings, or whether they just go off the rates notice, or if it's a required valuation, or that'd be interesting to see. And I guess they're hoping that if got some skin in the game and the market ticks along, and they'll be able to reap some benefit from that as well. And the people, the people have 75% equity in it at a minimum, because that's the maximum. The government will lend is 25, so they've got growth in that as well, if that works for them.
It's interesting. It's sort of akin to the HEX scheme in a way. Like, it doesn't sound like, how they index the amount that you owe every year in HEX. I know it's like, obviously they're not going to be indexing the amount that you owe in your mortgage or you owe the government, but in a way, if it gets revalued, it's doing that. But it's just at what point do they value it? So interesting. Yeah, cheers, Jolie.
Yeah,
very good one. And thanks, Wayne.
So in terms of the other bits and pieces, Arnie, was there any quick news items while I get up, and maybe you can run the Elon news, and I can get up the email that got sent out from Elon. I believe it was to the Twitter employees, maybe, or the Tesla employees. I can't remember if we found out about that one.
It was the Twitter employees. Yeah, I'll bring forward rapid fire news while you find the Twitter email about what they can and cannot do, which is pretty funny to see it leaked. So yeah, rapid fire news, guys. So Germany's Scholz has said that they take Russian nuclear rhetoric seriously, but will not be cowed by it. So that's a bit of an escalation in that part of the world. General Electric, L3 Harris Technologies, Textron Inc., and Veritas Capital are all vying to acquire Aerojet Rocketdyne Holdings. So that's interesting. FTX CEO John Ray will testify before the House Committee. The EU has said that it cannot seize Russian central bank assets for Ukraine. So, yeah, I guess they sort of have to go through the international courts to deal with something like that. US crude production grew by 2.4% to 12.27 million barrels per day. That's in September, the highest since March 2020. Elon has gone on the record on his own Twitter and said that Twitter interfered in elections before he came on board. So that's been picked up by the news, and that's very big news. And I guess people are now wanting to sort of verify exactly what he means by that. The EU has also warned Musk that Twitter faces a ban over content moderation. So if they do not sort of cede to what the EU wants in regard to their content moderation, then it will be banned all throughout. And more on that, the EU Commissioner, Thierry Breton, told Elon Musk that he must ditch an arbitrary approach to reinstate banned users and pursue disinformation aggressively, and agreed to an extensive audit of the platform. So it'll be interesting to see what happens there, because conversely, there was the news recently between Elon Musk and Apple, where Elon sort of alluded to the fact that Apple might be removing Twitter from the App Store, but that's since been resolved in a meeting between the two, and Elon's confirmed that will not happen. Before it was confirmed, Tim Cook and Elon had their meeting. Ron DeSantis, the Florida governor, and also one of the favorites to become president, either in this upcoming US election or the next, so 2024, I should say. He sort of said that, if Apple were to remove Twitter from its App Store, that might trigger some sort of antitrust investigation, or it would warrant something like that from the US government. And then the last one is the US House has passed a bill to avert a rate rail strike. So that's good news for the markets.
Good, mate. Great rapid fire update. Love it. Here's the email from Elon that was supposedly sent out to, we believe, Twitter workers in terms of, I guess, how he likes to run his businesses, and a CEO, I guess, setting the agenda early, filtering down to staff. It helps maybe the company run efficiently in the way he'd like it to be run without wastage. So, and a few really cool ones in here. So here they are. So one is avoid large meetings. Large meetings waste valuable time and energy. They discourage debate. People are more guarded than open. There's not enough time for everyone to contribute. Don't schedule large meetings unless you're certain they can provide value for everyone. I enjoyed that one.
Yeah, I think when you and I were talking about this, we all thought like that's common sense. There's more, isn't there, than that? Or
yeah, there is. Yeah, so 2, it gets better. Leave a meeting if you're not contributing. If a meeting doesn't require your A, input, B, value, C, decisions, your presence is useless. It's not rude to leave a meeting, but it's rude to waste people's time. I love that. Just getting up. Yep, not required. 3, forget the chain of command. Communicate with colleagues directly, not through supervisors or managers. Fast communication, make fast decisions. Fast decisions equal competitive advantage. 4, be clear, not clever. Avoid nonsense words and technical jargon. It slows down communication. Choose words that are concise, to the point, easy to understand. Don't sound smart, be efficient. 5, ditch frequent meetings. There's no better way to waste everyone's time. Use meetings to collaborate, attack issues head on, solve urgent problems. But once you resolve the issue, frequent meetings are no longer necessary. You can resolve most issues without a meeting. Instead of meetings, send a text, send an email, communicate on Discord. There you go, shout out to Discord, or Slack channel. Don't interrupt your team's workflow. It's unnecessary. 6, last one, use common sense. If a company rule doesn't, A, make sense, B, contribute to progress, C, apply to your specific situation. Avoid the rule with your eyes closed. Don't follow rules, follow principles. Hashtag Elon Musk.
That's fantastic. I feel like a lot of that makes sense, but like depending on what organization you work on, easier said than done. And it's funny how he followed up that point about if you can't contribute to the meeting, then just get up and walk out.
Oh, mate, that's it. That's a textbook kind of higher functioning, almost Asperger's-y type. Oh well, I'll leave. I don't care what people think. It's funny in Insto world when I was there, it was constant. We had fortnightly meetings and daily meetings and monthly meetings, and it's like, what for? But yeah, I would have loved to have walked in one of them.
Could you imagine just getting out, walking out with no explanation, and then like someone sort of stopping you and be like, "What are you doing?" And they're like, "Oh, I'm not contributing to this meeting, so I'll see you later."
But is that why Tesla's successful? Is that where his take is that with a modern company? Is that the forward thinking company?
Well, and then following up that point about walking out with like forget the chain of command. It's like obviously it's like the CEO saying this or whatever, or the owner saying it, so it's easier to say when you're high up the hierarchy. But on that point, like, is this why he's successful? I was listening to the Lex Friedman podcast on YouTube maybe a couple of weeks ago, Jolly, when he interviewed Chamath. And Chamath said something similar. He sort of said, hate meetings. When people start social capital, we tell them that we don't want meetings. And if there's a meeting scheduled, you basically have to justify why. And if there is a meeting, they've got a cap on their meetings there at 15 minutes. No meeting can go longer than 15 minutes.
That's cool.
Yeah.
I love that. Yeah, great. So yeah, we thought the listeners would enjoy that blunt email from Elon as part of the Elon-centric period of the podcast or time of the podcast. Anything else to touch on, Arnie, before we get to our favourite listeners' favourite segment, which is the 50-50 or what's your choice?
No, I think we've covered everything, mate. Yeah.
Beauty. So with the 50-50 or what's your choice this week, it's a sport-themed one in the honour of the World Cup that's going on at the moment. So I was keen to hear Brad's thought on this one as well, but it'll be myself and you, Arnie. We did briefly touch on it, which we don't usually do with 50-50s, but just to gauge where the question was going. So it's probably going to be a third. This one is, if you're watching a soccer game, so let's say the Socceroos in their World Cup campaign at the moment are doing well. If they've got a 2 a.m. game, let's say, or any sporting event, it doesn't have to be soccer if you're not into soccer, but a 2 a.m. game, are you A, staying up to watch the game at 2 a.m.? Are you B, going to sleep and then waking up at 2 a.m.? Or are you C, trying to avoid social media at all costs, waking up at 6 a.m. to watch the game on replay?
I am definitely setting my alarm and waking up for the game, because I feel like it's impossible to avoid social media these days. Like, unless you are so disciplined that you got your phone turned off and you won't look at it and you got the game recorded, it's safer just to get to bed early and then wake up early to watch it. What about you?
That's a very good one. I would wake up for the 2 a.m. game if it was a big game, like a Socceroos game, as an example, just to enjoy it live, I guess, and then go back to sleep again. So I try to get to bed a touch earlier. But in general, I'm okay with waking up at 6 a.m. because I'll flick my phone to do not disturb, which stops all notifications coming through. But I do need to obviously stay off the phone then. So getting up at like a 5:30 or a 6 a.m. to watch a replay, not as exciting as watching it live, because you're sort of, you're not there feeling every blow by blow. And it's a strange, surreal feeling waking up a bit kind of like, head fuzzy at 2 a.m. to watch a game, but then you start to wake up and you get into it. So there you go.
Wait, so which one did you choose? You would wake up at 2, or you
for a big game, yeah, like a big World Cup game, I'll wake up at 2. But generally speaking, a large portion of the time is I'll wake up at 5:30 or 6 and just watch it on replay.
Yeah, I'm the same as you. Yeah, sorry. If we're specifying, definitely get up for the large occasion. If it's just something like, I don't know, like an NFL match, I want to know that, I want to watch. Yeah, just hit the replay a bit later.
Big event though. Got to get up.
Yeah.
Be part of it. Got to wear the passion on the sleeve.
Go to Socceroos.
Yeah, absolutely. Go to Socceroos. So hopefully kicking into round 16, let's hope. So in terms of the podcast, Arnie, where can the listeners get us at?
Get us at Money in the Tank on YouTube, Instagram, Twitter, and Facebook. And on YouTube, leave a like, comment, subscription, please. And if you're a subscriber, please hit the notification bell. Helps us.
Absolutely.
And if you're listening and you're not yet subscribed, please do so.
Thank you very much. And any questions, feel free to flick them through. We love answering your questions in Q&A time. And hopefully you've enjoyed this episode 54 of Money in the Tank. We'll see you guys next week.
See you later.
Cheers all.